Welcome to the podcast series, Interest Rates with Mates, with Colin, Todd, and Sean. Welcome everyone, Interest Rates with Mates, episode number 2. First episode, that was very exciting for us, and yeah, we're just continuing on and doing what we do. So today I thought a good talking point is the past 24 months. Let's break it down. Colin, been in the industry 22 years. This is probably a good topic for you to speak on because you've seen the change firsthand over the years.
Absolutely. Obviously, it goes without saying that the last 24 months we've seen some things that we probably won't see again, hopefully. But look, the things that we have seen in the banking environment is traditionally we have rates around 5 or 6%. The last 24 months we've had rates around 1.79% or upwards from there. We've had historically low assessment rates as well. So the assessment rates is how lenders test borrowing capacity, and that's been at low rates, 5.25% for example, which again we haven't seen that that I can recall ever. So borrowing power has increased over that last 24 months because of those low assessment rates and those low fixed rates and variable rates.
Just on that borrowing capacity, what would you say a good gap would be between 2 years ago and now for the average household?
In terms of the assessment rates?
And borrowing capacity.
Borrowing capacity, over the last 24 months, so if we backtrack now 2 years ago, borrowing capacity would have increased by around $200,000 to $300,000, just as an approximate for most households, which is a lot of money.
Painful.
And a lot of money. And obviously what we're now seeing is as the rates are now increasing, obviously for 9 consecutive times now, that's put a dent in that number.
Yep.
Where that's going, who knows? We can forecast. But for a lot of households, they've been able to purchase a home, but they've had to increase the amount of credit to buy that home because house prices have gone through the roof as well.
And Todd, on that market sort of discussion, what's your take on the house market rise in the past 24 months? And is it sort of plateauing, or what would you...
Yeah, well, it comes back to the assessment rates, doesn't it? Because, if people can borrow more money, they're going to spend more money. If interest rates are really low, at record lows, obviously the repayments are cheap. So, and I think that's what's just really caught everybody off guard. The assessment rate was only at 2.5%. So that means that the bank's assessing people's affordability at 2.5% above the actual rate of interest that they're actually applying for on that loan. Obviously, during COVID, with the record low fixed rates and the variable rates all in the higher ones, low twos, the regulators stepped in and increased that assessment rate to 3%. Sure. So, look, it's with cheap money, obviously people are going to spend more, and I think that's what's ultimately fueled the price growth in properties.
And we look at the whole supply demand as well. Like there was probably not enough supply on the market, but a lot of demand based on those low rates, and we had government incentives as well around first home buyer incentives.
Home builder, $25,000 home builder.
Home builder to build. The building industry is obviously as busy as ever right now.
And Todd, you were saying about finance clauses as well, just on the house market.
Yeah, so during the craziness of COVID, when the property market was just booming, I was just sort of talking earlier about finance extensions weren't really a thing. Vendors and real estate agents would have backup buyers. So if the first buyer didn't quite meet that 14-day finance clause, they had backup buyers ready to go. And a lot of the time, some of those buyers were cash buyers. So there was a lot of stress around meeting that finance time frame. And because the banks were getting record volumes as well, the banks were quite slow. So we'd get the application, processed, and we'd meet with the client and we'd get it all submitted off to the bank. But then that turnaround time was really slow. So whereas now, sort of in the changing market, the finance condition, there's not always backup buyers. So getting a finance extension by 1 or 2 days is normal again, and that's okay. But it's more so with the tightening or with the increasing assessment rates, increasing interest rates, sometimes we need to do more due diligence up front, because the clients might only qualify with one or two lenders, not every lender. Whereas back during COVID with low assessment rates, everybody qualified for a loan. It was cheaper. It was so much cheaper to buy than rent. So,
and I think if we have a look at the past 6 months, we've started to see some of those changes from the lender. So some lenders have come out with policy changes, which are helping to increase people's borrowing capacity, i.e. one being self-employed. So some lenders are actually going 1 year in isolation, which is good, because obviously during COVID, businesses struggled to do an income. And obviously as they've started to get back on their feet, they've generated more income. So lenders appreciate that, and they understand that COVID was a hard time for some people. And so that's one of the policies that we're really starting to look at.
And the lenders did tighten a lot of those policies during COVID.
Yes.
Like pre-COVID, we had, 5 or 6 lenders that would accept 1 year's financials. And then, during all those COVID lockdowns and all that, a lot of the lenders tightened that policy or removed the policy altogether. So we only ended up with 1 or 2 lenders that would accept 1 year financials. Casual income's another thing. I'm hoping we see a little bit of relaxation around casual income policy in the future.
I totally agree.
Back to 3 months.
I think the other thing too with the Sunshine Coast is there's a lot of households that are self-employed. They run their own businesses, and there's a lot of casual employment up here because of the hospitality industry, tourism, etc. So I think, agree with you, Todd. I think the lenders will have to improve casual policies. I think there's already a few enhancements there across the lender panel. But the other thing with self-employed too is through the pandemic there was a lot of government stimulus, your job keepers, your COVID cash flow boosts, etc., which a lot of the lenders initially wouldn't use that income. But now they are using that income, and I think for a lot of businesses who have lodged their 2022 returns, a lot of that income wasn't there anyhow, but definitely if we're still relying on 2021 financial year, that income's still there, and it's important to know that because lenders will now use that income, and that'll obviously in turn help with borrowing capacity.
And the government's word of releasing a new grant later this year as well. So that's obviously going to help a lot of people in terms of looking forward to the next 6 months, which will be good.
Yeah, absolutely.
And I guess as brokers, how do we help? So if we look at 2 years ago till now, I think you've said it before, we've got access to 60 lenders.
Absolutely.
Policy niches are a big thing because not everyone earns just a full-time wage. There's casual, there's overtime, there's allowances. So that's what we do well, is because we have access to all of those lenders, their policies, and we know which one will suit them.
Yeah, and I think it's important to note there too that because of our the size of the business and the relationships we've got with majority of our lenders, we do get in the fast lane a lot. So Todd, you spoke about timeframes before. Most of your major banks and your non-bank lenders as well, we get express service. So, like generally speaking, we can get 1 to 2 day turnaround timeframes as well. So, once we lodge an application, if you're on a short finance timeframe, we can generally turn it around relatively quickly. The other thing we're big on at the moment is the pre-approvals as well, because the market's changing and rates are changing. If you pre-approve yourself now, you've got 90 days generally with most lenders to find that perfect home to purchase, regardless of rates going up, etc. They won't reassess on those new rates. So I think that's really important at the moment as we're going through change.
Absolutely.
For customers thinking about spending money on a property or at least understanding their borrowing capacities, to give us a call as well.
And I think we're looking in the next 6 months, people will be coming off those 1.79, 1.89 fixed rates. So
fixed rate cliff, I think they've called it, haven't they?
It's a big cliff. It's a big cliff, and we've already started to see some of those people come through, and it's a big shock.
Yeah, definitely.
Yeah, and I think it's important to highlight the service that we offer our clients.
Yes.
In that regard as well. I mean, we've got Georgie, who's full-time in our team, who predominantly services our current clients, but also new clients that want to renegotiate their rate with their bank.
Yes.
Now, we're happy to do that on behalf of anyone that's not even a client of ours yet, just to show, the level of respect we've got for the market, and obviously our listeners and our current clients as well. But I think it's really important that we try and stay ahead of where those rates might be going, and doing a simple renegotiation with your current bank, which we can do for you, I think is really important.
Absolutely. So I reckon that sums it up. I mean, the past 24 months has been tough for a lot of people, but I think slowly people are getting back on top of their feet. We'll see a lot of good policy niches come out this year, I think. Todd, what do you reckon?
Yeah, definitely. And the biggest things are like that repricing. Like I've spoken to a lot of clients, after the the latest interest rate rise. There's lots of concern about when's it going to stop. My interest rate, my repayments have increased significantly since I took out this loan 6-9 months ago. So just, get in touch if you want us to do a quick rate review on your loan. As Colin said, whether you're an existing client or not, it doesn't matter. We can go into bat. We can negotiate that rate with your existing lender, because at the end of the day, the banks, they pass on the full interest rate rise to existing customers, then offer bigger discounts to new customers. So, if you've been with your lender for even 4 to 6 months, that rate's probably already a touch too high. So,
and there's cashbacks as well.
That's right.
Cashbacks are in there. Whether you like it or hate them, they're there. And for some lenders, they're doing $3,000 and $4,000 cashbacks. There's one particular lender that might even do $6,000 to $9,000 in cashbacks, depending on how many loans you've got. And again, like I said before, there's so many different policies and enhancements, etc., out there at the moment. I think it's important to get the advice from an expert.
Very good. So, 24 months, I reckon we broke it down pretty good. As always, thanks for joining. This podcast will be available on all platforms, and we're looking forward to seeing you next week. We'll see you then.
Thank
See you
you.
later.